I've been buying businesses and stocks for a lot of years, stocks for 71 years and businesses for almost as long. And I've never really made a decision based on macro factors. If I find a business I like, I buy it. I mean, the first stock I bought was in the spring of 1942, and I will tell you the macro factors were not looking good. We were, it was right after Pearl Harbor, and we were getting clobbered in the South Pacific, and the war did not look good. Now, I think almost every American thought we were going to win the war, but when I bought my first stock, I went in 100%. I spent all my $120. I was not doing it based on headlines. I was doing it based on what I was getting for my money.
But when you did that, when you bought into it, and you say you don't look at macros, I can think of times in the past when you have looked at macro effects. When you looked back with stocks at a low, you told Americans to buy stocks with both hands.
Well, occasionally, stocks are just demonstrably cheap. I mean, really demonstrably cheap. And I wrote an article in 1974, or I did an interview with Forbes, and in 2008, I wrote an article for the Times. And I mean, there are occasionally when they're just ridiculously cheap, but most of the time they're good value. But there have been a few times when I thought they were so cheap that I should say something.
Do you think that real estate and other areas are better places for money than stocks right now?
No, but they're speculating wrong. I use those illustrations because I don't know that much about real estate or farms, and yet it was still possible to successfully invest in them. And I feel the same way about people on stocks. You can have a great lifelong experience in stocks and really not be a specialist in accounting or know all the ins and outs of capital structures and all of that sort of thing. And I was probably more ignorant of the realities of farming, the realities of that building in New York than most people are of stocks. And yet it was perfectly possible to come to an intelligent decision that you could not lose money in those investments and that you were probably going to make quite a bit of money.
Bill O'Reilly said this very recently, that he doesn't trust the stock market and thinks it's rigged. What do you tell people?
Well, it isn't rigged at all. I mean, there have been occasions when given stocks perhaps have been rigged, but it's pretty hard to rig $20+ trillion. I mean, and people should forget about it, calling it the stock market even. I mean, it's American business. And if for some reason you think American business over the next 50 years is likely to be way less productive than it has been in the past, then you could come to a negative conclusion on it. But I came to a conclusion on that farm that it was likely to produce a little bit more over the years and that the crops would bring a little bit more over time, and I bought it on a 10% yield basis to start with. So when you're buying a productive asset, you don't want to categorize it by some name and then read in the paper that this or that's going to go up or down. You want to look at the business. If you bought the house next to you to rent to somebody, you'd look at the rent you were going to get, the taxes you were going to pay, and what you thought the neighborhood would do over a long period of time, and then you'd measure that against the purchase price. The purchase price is all important, and the stock market just offers you so many opportunities. Thousands and thousands of different businesses. You don't have to be an expert on every one of them. You don't have to be an expert on 10% of them even. You just have to have some conviction that either a given company or a group of companies, and I would suggest for most people it should be a group of companies, you have to have a conviction that those companies are likely to earn more money 5 or 10 or 20 years from now than they're earning now. And that is not a difficult decision to come to.
You laid out the terms of your will, what you've set aside for your wife, which I didn't know any of this.
Yeah. Well, I didn't lay out my whole will. There's hope for some of you who haven't been mentioned yet. But I did explain, because I laid out what I thought the average person who's not an expert on stocks should do. And my widow will not be an expert on stocks. And I want to be sure she gets a decent result. She doesn't need to get a sensational result. And since all my Berkshire shares are going to philanthropy, the question becomes, what does she do with the cash that's left to her? And part of it goes outright, part of it goes to a trustee. But I've told the trustee to put 90% of it in an S&P 500 index fund and 10% in short-term governments. And the reason for the 10% in short-term governments is that if there's a terrible period in the market and she's withdrawing 3 or 4% a year, you take it out of that instead of selling stocks at the wrong time. She'll do fine with that. And anybody will do fine with that. It's low cost, It's in a bunch of wonderful businesses, and that takes care of itself.
You specifically said a Vanguard index, which caught my attention.
Yeah, well, it's a very, very low-cost index fund, and there are others, but there are others that aren't so low cost. And keeping costs to a minimum is enormously important in investing, whether it's farms or buildings in New York, but particularly in stocks. I mean, if you're in effect paying out 1 or 2% annually of your portfolio, that's a big, big tax that you don't have to pay.
And people who are at home who are listening to this, they just need to look at the expense ratio. And you could probably get one for 20 to 25 basis points versus 100 to 200 basis points.
That's right. And I think Vanguard's actually a little under 20 basis points. And if all of the people that had owned Berkshire 40 years ago had never traded, every day they tried to open the stock and there just wasn't anybody there to trade it, their returns in aggregate would have been exactly our returns. Now, if they traded around like crazy, if they pay people to tell them to own it and everything, their returns become our returns less expensive. So you should look for a very, very low expense way of participating in securities. And incidentally, at Berkshire, our expenses are very, very low in relation to the $100+ billion of investments that we have.